Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Now, this show gets you actionable insight on everything mutual fund related, whether it is fresh investments, whether it is managing your existing portfolio. And it is now the time when we're nearing the end of the financial year. And quite a few of you know what that means. It is the time to make your last minute tax-saving investments. That has been the case for many years. Of course, some of you have migrated to the new tax regime and so don't have to worry about this, but quite a few of you are still on the old tax regime. Now, it is also the time when the mutual fund industry receives a significant amount of flows into one specific category, and that is equity-linked saving schemes, or ELSS. That has an AUM even as of the end of February of over 2 lakh crore rupees. It is the 6th largest category. I just checked the numbers. What we're discussing today is whether you should consider investing in this particular category still, or whether you should change your strategy. And if you are to invest in the ELSS category, how should you differentiate between the various schemes and which should you choose? So to answer all of those questions, I've got a couple of guests on today's program. We've got Aditya Nain, who is author, professor and creator, and we've got Kalpesh Ashar, who is CFP, Full Circle Financial Planners and Advisors, and he's also a registered investment advisor. Thank you so much to the both of you for taking the time. Let's start with what this scheme is about. It's one of the old categories that has been available for investors, and it is popular primarily because of the tax-saving nature of it. Aditya, what can you talk about in terms of what this scheme is meant to achieve?
First, thanks for having me, Alex, and I'm sorry about my voice. I'm struggling, just come down with a cold. So this scheme is meant to give you two things, really. One is, up to 1.5 lakhs in a tax deduction under Section 80C of the Income Tax Act. So if you invest 1.5 lakhs, you get the deduction of up to 1.5 lakhs, not more than that. And the second thing is equity-linked growth. So because these mutual funds and schemes invest in the stock market, unlike, say, putting your money in the PPF, you get returns that are linked to the stock market, which are historically much higher than fixed income options like the PPF for 80C.
And thank you so much for joining in despite your cold. You don't sound bad at all. It's perfectly fine. If anything, you sound better. Let's talk to Kalpesh as well. Kalpesh, do you want to add anything to this? There's that lock-in period also to take into consideration.
Yeah, absolutely. And Alex, great being on show once again. And the topic which we are discussing is, like what you rightly said, it's been on for a very long time now in the mutual fund space. And primarily it's to be looked upon only as, I would say, equity-linked tax saving option. That's what it's popularly known to be. But if you deep dive into it, and open up the ambit of mutual fund investments per se, then I think investors should look at it again like an open-ended equity investment more than 3 years, and not get too, just bogged down by that tax saving which is available for an individual only in the year which he or she invests in to get that tax benefit as under Section 80C. So equity-linked saving schemes is a great option for people to, save tax up to that 1.5 and also get their foothold into equity. But then it's not only to be seen into that context and, move out of it if the fund is doing good, but continue it as a holding in their long-term portfolio of the equity component.
Aditya, the question about who this is best for is also relevant to ask, I think, because I think once people progress in their careers, and this is primarily, of course, used by salaried individuals, individual taxpayers, but as they progress in their careers, a large percentage of that 80C is taken care of by the automatic contribution through the Employees Provident Fund. And so they find less and less requirement to make the rest of that 1.5 lakhs. So would it be fair to say that this is better for those that are not making this investment, that is professionals, and also individuals that are early in their career and earning therefore less?
I think that's true, Alex, to an extent, but I think even so far, even people who make the regular automatic EPF contributions, and let's say they have a term insurance policy, because even the term insurance premium gets covered under ATC. So once those two are ticked off, you still have people, just anecdotally, who still have some space for an ATC deduction. Let's say, and usually, yes, this is for early stage professionals. Once you reach a certain threshold, then your EPF and your term insurance would probably cover all of it. But for early stage professionals, you still have that shortfall, I guess, after your EPF and your term insurance that you can go with an ELSS for. Just an anecdotal reference, I took a poll on my Instagram, which was, not very scientific, but more than 50% of the maybe couple of thousand people who responded said that they still file under the old tax regime, and about 20 to 30% still are not sure about which regime they file under. So although there is this sense that people are moving to the new tax regime, you still have a lot of people who are figuring it out or who are going for the old tax regime. And a lot of these people are the younger 20 to 35-year-olds, and so they will need to cover up on that ATC deduction.
To add to that anecdotal evidence, and hopefully we will get data, and if I'm not mistaken, the last data that was available did point to more people choosing the old tax regime, and I think the reason for that is quite simple, because if you do the math, and if you look at those people that are either paying back the loan on a house, and so therefore paying back a principal, or rather the interest component of that, or those that are living on rent and therefore claiming your house rent allowance, HRA, is quite significant in that particular band of 20 plus to about 35. And so therefore these individuals benefit from claiming the old tax regime. But having said that, Kalpesh, the most important point to ask in this ELSS category is, if you have that gap, should you choose the ELSS or should you choose something else? And if you don't have that gap, do you then stop investing in the ELSS completely?
Yeah, so going by the personal finance textbook, if you were to see like what Aditya mentioned, that if EPF, which happens by compulsion, takes care of your fixed income component, and there's no better instrument in fixed income than an EPF contribution going, because at whatever more than 8% type of an interest, tax-free, I think that takes care of your fixed income automatically. Then the next best thing is if your term plan is in place and the premium takes place automatically for that. And if there's any room for that, equity should find that much spot in a portfolio of that ATC deductions under the old tax thing. Now, if it does not fit, which is the second thing, so for example, the 150 is packed with these two mandatory things, then I think then people should not be looking at an ELSS scheme, because there the 3-year lock-in period comes in. And if we deep dive into the features of these ELSS schemes, then I think you're better off going with an open-ended scheme to prop up your equity component in your existing portfolio. Because then it's absolutely illogical that why would you want to stay in a scheme for 3 years lock-in period and not open yourself more to more diversified type of funds. Because as we've seen the research and the fact sheets that predominantly, Alex, these ELSS schemes rely a lot on the large cap schemes which are there in their portfolio, large cap stocks in their portfolio. Very little tread into the mid and the small cap territory. So then it's better that it's always taken care outside in the open-ended category.
No, it's a fair point, but I do want to ask the flip side to that, just to play devil's advocate, Aditya. Kalpesh's point is that you have limited benefit, and this lock-in period is not desirable. However, some people from the other end of the spectrum look at it saying that, look, I have no choice but to stay invested for 3 years. And ultimately, the objective of an equity scheme is to stay invested for the long term. At least 5 years is what a lot of advisors like yourself suggest. So is it such a bad thing to have a lock-in for 3 years?
No.
The question is to Aditya.
Sorry.
I guess yes and no, Alex. I'll put it this way. some people need to put all their money, let's say, in ELSS, all their investments in ELSS, because they don't have excess to invest over and above that. I think for these people, it would be better to go with a non-ELSS scheme, let's say a flexi cap. Well, I think of a flexi cap really as an ELSS without the tax, or an ELSS as a flexi cap with the tax benefit. It's sort of the same structure in terms of what they invest in and how they invest. So for people who may need that money to be taken out in case of an emergency, even though they may have an emergency fund set aside, nonetheless, if they don't have too much excess liquidity, too many investments to their name, it's nice to have the option of being able to draw funds out when you need it during an emergency. So I see no compelling reason to take that lock-in. I know it becomes a forced lock-in, but then it's a question of are you disciplined or are you not? Maybe if you know and you're aware that you're really not a disciplined investor, then maybe it's a bit of a hack to go for the ELSS so that you're forced to be locked in. But for most people, I'd say only use it for the ATC deduction. You don't want an unnecessary lock-in when you can get the same sort of product without a lock-in.
We're talking about tax-saving investment options in the mutual fund space, and of course, that is the ELSS category. And what we've established to this point is that if you have a bit of a gap in your ATC deductions, and if you are on the old tax regime, obviously, then perhaps you can consider ELSS. Of course, that 3-year lock-in is not something that is very desirable, is what both our experts today have said. Now, when it comes to actually making these investments, what should you bear in mind? Kalpesh, the form of these is very similar to flexi cap schemes and therefore oriented towards large caps. Is that by and large what you see across the category?
Yeah, absolutely. That's been the trend, and I think we've been following these categories now and doing a lot of talk and research on that, and obviously recommending schemes uh, also. So the trend has been that the alienation has always been aligned towards the large cap schemes, primarily that given that it's a 3-year lock-in period and you don't want volatility to surface by playing in the mid and small cap category in that short period. So the fund houses take the safer route and put, I think, majority 70 to 80% of their money in the large cap stocks. So that's been the trend. But here, obviously, that's where an advisor or a distributor, a diligent advisor or distributor comes into the picture. That when selecting these funds for a portfolio, if you want to go in for an ELSS funds, you could select certain funds which have a little divergent type of a thing where the exposure, if not in a portfolio, is not there to mid and small caps. If some ELSS is doing it by default or at a particular time of portfolio rebalancing, if a person has more of mid and small caps, he could take an ELSS just to prop up the large cap segment. So that type of, I think, balancing has to be done, but you need an advisor to do that because a normal DIY could not do that because 70 to 80% of the schemes today are large cap heavy. And like what Aditya said, obviously more on the flexi type of functioning. So you should have that type of balance in your portfolio. Otherwise, there's going to be a lot of overlap, and you could not probably generate an alpha then.
That's a fair point. Aditya, do you want to add to this in terms of how do you differentiate between the various schemes in this category? Do you, would it be fair to say that most of them can be painted with the same brush? There's largely not very much of a difference in the management?
I would say yes, I agree with that. And I think investors are spoiled for choice when it comes to ELSS schemes because they are all pretty much along the same lines. Large cap heavy, and if some of the schemes that I've been looking at have about an average of, let's say, 15 to 17% given to mid cap and a sprinkling of, point something to 3% on small caps. So, of course, some fund houses will have a focus on a particular sector at one point in time. Others may take a focus on another sector at another point in time. And so stock choices would change, but there is a lot of overlap. And they are, of course, very large cap heavy. And so I would think personally, when I look at ELSS funds, I look at a lot of the quantitative metrics that it's easy for any new investor or beginner to gauge on any website online. So simple things like, how long has the fund manager been managing the fund, what's the AUM or the assets under management of the fund, or what's the expense ratio, what are the risk metrics, what have the returns been like, have they been consistent or not, some portfolio metrics like the scheme's PE ratio. So there's some things that everyone can just work down a checklist and tick off. And so I think that makes, because there are so many that do pretty much the same thing, you can go for the best of the best based on whatever parameters you care about a lot. So one investor may say that, look, I want a fund that has a very long track record. I'm only going to look at 10-year plus fund age. Another may say, I want a fund that, invest in mid caps more. So they'll go with something that has a little bit more of mid cap. So, some may just say, look, I'm going to go for the one that, is top rated and has the lowest expense ratio. So you can play around a lot with this. You have a lot of options.
So to that last point, Kalpesh, this one's for you. Not too long back, there was the allowance of creating a passive strategy in the ELSS category. Not many options available, but there are. There is at least one that is coming to mind. The question is that since a lot of these ELSS options are large cap oriented anyway, and if a Nifty 50 index is available to invest in with an ELSS tag, then why shouldn't you go for that?
Yeah, so again, Alex, like it's got its roots in the last question, what we said. So this cannot be seen in isolation. Passive fund is the right way to benchmark, against the index. And if an ELSS is doing that, then why not? You've got a 3-year lock-in period. But again, the other side of fund management, which is the active side, obviously, that in getting stuck to a certain index or a certain benchmark, which we say, doesn't let that fund manager, be in a active mode or make those necessary changes which he would like to make. Obviously, that comes with a cost. We understand that. But then why not let that fund manager have that flexibility and move according to the times? But more importantly, on a macro manner, your portfolio composition is very important, whether you should be going for a passive ELSS or your active ELSS, which are there right now. Because it's not the only fund in your complete portfolio which determines your returns, right? So you need to see that and then accordingly take a call whether you want a passive ELSS or an active ELSS in conjunction with your entire portfolio. So if your entire portfolio is skewed with active, say, risky funds or mid and small cap funds, no harm in taking a passive ELSS fund. But that needs to be seen in entirety.
And to that point, Aditya, then suppose I'm an individual that is pragmatic in their approach to investing in equities as a whole and has done something like a 30-30-30 towards large, mid and small and has a 10% tactical allocation, which I think a lot of people agree is a decent thing to do for someone with a reasonable risk appetite. Why shouldn't that ELSS passive be part of the 30?
No harm in doing that. If it turns out that you need that, you're falling short on that 30%, you can get your large caps through your ELSS. As far as I know, there are a couple of schemes that benchmark to the Nifty 50 that are passively managed that track the Nifty 50 on the ELSS side. So that does make sense. But I think the one point about mid caps being added to these ELSS actively managed funds these days is important. Because if you do have a mid cap allocation, even if it's about 15%, you are, I think, going to get an outperformance over the long run when you average out the returns from these actively managed funds, even if they don't do extremely well benchmarked to their own benchmarks. I think you would still see a lot of them beating the Nifty 50 index. But yes, for those who have the 30% allocation to large caps, ELSS, whether active or passive, would be a good option to fill that requirement.
Okay, fair point. And we have, in fact, got the schemes that you like, Aditya, and we're playing that on the screen, or we have been playing that on the screen as well. There is a question that we have received that is related to equity-linked saving schemes, and this is from Swayam. He says that he's 28 years old. He says that he's got multiple ELSS funds, all direct plans, which he's invested in and which have matured, and he's looking for some liquidity at this current juncture. And he's wondering, with bond yields where they are right now, would it be prudent to book the profits that he has gained over a period of time and shift into something like a bond fund? And he's got an urgent requirement of about 1.5 lakh in cash. He's listed several, and I see about 7 or 8 at the very least of the schemes that he's invested in. So Aditya, way too many ELSS schemes of different fund houses. Should he book, and I'm not getting into the details because he's practically invested in everything. So should he book and move into bonds?
Well, I think it goes back to the primary question of, do you need the money in the short term? If you don't need the money in the short term and you still have that long-term time horizon of 5 years plus, then there's no compelling reason really to move out just because you've seen some gains. You can always see possibly more gains over the next 5 to 10 years. But if you do need the money, if you anticipate that you have a purchase coming up or something for which you need liquidity coming up, then now would be a good time with the markets quite high to book some of that profit, as you said, since the lock-in period is over. And but bond funds also come in all shapes and sizes, right? They're not all safe, quote unquote. So, for example, you don't want to go into a credit risk fund, but maybe like an ultra short duration or a liquid fund or a low duration fund. These could be options as long as you need that money and there's a compelling reason why you want to take the money out, not just because you can.
Quick follow-up to that, you wouldn't suggest a duration here, like maybe a corporate bond fund or a gilt fund or even a target maturity fund?
I think for shorter time horizons, that's under 2 years, my comfort is towards low duration funds at the higher level of the risk spectrum.
But my understanding was that he's going to take some cash and he's going to invest the rest. So if he's investing for the longer term, then he should look at duration, yes?
Yeah, I would say mid to long duration is not a bad time to get into these, given the interest rate environment, possibly with rates coming down in the future. Not a bad play. Yeah.
Okay, Kalpesh, one last follow-up on this, and I was counting the number of schemes. There are 11. There are 11 ELSS schemes. So even if he is to stay invested, would you suggest that he'll reduce the number quite significantly and focus on, what, 1 or 2 at the very most? I don't want to put words in your mouth.
Yeah, so absolutely. I think, the question itself puts words in my mouth. So that 11 is too much to fathom of ELSS, and it's completely, I would say, without even going deep into it, that it's a completely large cap oriented portfolio. Nothing wrong in it, but it's a large cap oriented portfolio, and obviously not calling for anything to do with diversification. He needs diversification. If his horizon is obviously longer, a good flexi, multi, and a mid cap type of a combo could be good. And 100%, not more than 1 or 2, I think ELSS schemes in any portfolio should do the job for anybody. And as far as his liquidity concerned, from a pure financial planning perspective, if you need the money, just come out of it. Like what Aditya said, also the markets are doing well, then why wait for it? Use it for the desired purpose. And if it's a little bit more than 2 to 3 years, go into these AAA rated corporate bonds or something and play that little duration game. Otherwise, keep the powder dry with your ultra short or money market type of funds right now. But he needs diversification. 11 schemes, bit too difficult to digest.
Fantastic. All right. Aditya as well as Kalpesh, thank you so much for joining in and for speaking to us on the Mutual Fund Show. And, Swayam, I hope that your question is answered. And viewers, I hope that this makes your decisions a little easier towards the end of the financial year. Do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.